Hi, I'm Andy Temte, and welcome to the Saturday Morning Muse. Start your weekend with musings that are designed to improve financial literacy around the world. Today is November the 1st, 2025. Last week, we witnessed the South Sea bubble's spectacular collapse and saw how informal coffeehouse trading evolved into the London Stock Exchange by 1801. Stock markets had progressed from chaotic speculation to organized institutions with rules and oversight. Throughout the 1800s, another crucial transformation occurred. Stocks evolved from elite investment and speculation opportunities into investment vehicles accessible to the middle class. Today, we're exploring how this democratization shaped our modern understanding of stock markets as barometers of economic health. So, picture America in the 1830s. The young nation is rapidly expanding westward, but traveling between cities requires weeks of dangerous journeying by stagecoach or maybe a canal boat. The country desperately needs better transportation. The Baltimore and Ohio, America's first commercial railroad, began operations in 1830. Within 2 decades, railroad construction exploded. By 1850, America had laid 9,000 miles of track. By 1860, that number had tripled to almost 30,000 miles. But building railroads required a staggering amount of investment capital. No individual could finance hundreds of miles of railroad. The solution was the joint stock company model that the Dutch had pioneered with the VOC. Railroad companies would issue thousands of shares, allowing investors to own small fractions of enormously large and expensive enterprises. Now, before railroads, stock trading in America was modest, mostly bank shares and government bonds limited to wealthy merchants. The New York Stock Exchange, which was founded in 1792, handled perhaps a few hundred shares daily. Railroads transformed this. Between 1830 and 1860, railroad companies issued hundreds of millions of dollars in stocks and bonds. Suddenly, middle-class Americans, doctors, lawyers, shopkeepers, and farmers could participate in financing America's infrastructure boom. This expansion in trading created demand for information. Investors needed data about which railroads were well managed and profitable. In 1849, Henry Varnum Poor became editor of the American Railroad Journal, transforming it into a comprehensive source of financial information, balance sheets, income statements, and management profiles. His work laid the foundation for what we know of today as Standard & Poor's, one of the big 3 global credit rating agencies, and established a principle central to modern investing, which is informed decisions require accurate financial information. Here, financial analysis became a profession. Sophisticated investors studied company finances and calculated valuations. The idea emerged that stocks had quote-unquote intrinsic value based on business fundamentals, not just the whims of speculators. Now, as railroad stocks became ubiquitous, people began watching overall market trends as indicators of economic health. When railroad stocks rose broadly, it suggested confidence in America's expansion. When they fell, it signaled concern about future growth. The concept of, quote-unquote, the market, or the aggregate performance of all traded stocks, emerged during this period. In 1884, Charles Dow created the first stock market average, tracking 11 companies which were mostly railroads. This evolved into the Dow Jones Industrial Average, which is still one of the world's most watched market indices. Dow's innovation allowed investors to discuss the market as a measurable entity, whether it was up or down, optimistic or pessimistic. Now, railroad stocks brought stock ownership to the middle class in unprecedented numbers. By the 1850s, tens of thousands of Americans owned railroad shares. These were teachers, ministers, small business owners, and professionals. This democratization happened for several reasons. First, railroad shares were relatively affordable, many trading for $50 to $100, which was within reach of middle-class savers and investors. Second, railroads paid regular dividends, making them suitable for income-seeking investors. And third, railroads were understandable businesses. People could see trains, they could ride them, and they could grasp how they made money. Whereas the ships and the ocean trading was a fairly foreign concept for the masses. This broad ownership created political constituencies that cared about stock market performance and corporate governance. When railroad companies failed or engaged in fraud, thousands of investors lost money, creating pressure for better regulation. Now, democratization also meant market crashes affected far more people. The Panic of 1873, which was triggered by railroad financier J. Cook and Company's bankruptcy, demonstrated this painfully. When railroad construction outpaced transportation demand, companies couldn't service their debts. Stock prices collapsed, banks failed, and a 6-year depression followed. Thousands of middle-class families saw their savings evaporate. This crisis taught crucial lessons. Legitimate businesses can be overvalued when investors become too optimistic. Leverage, which is the use of debt in a company's capital structure, magnifies both gains and losses. We're going to learn a lot about leverage in future episodes. Also, diversification matters. Investors who owned multiple railroads fared much better than those concentrated with investments in just one. And as you might expect, we're going to talk a lot about diversification too in future episodes. The Panic of 1873 revealed that stock markets amplify economic problems. Falling prices made it harder for companies to raise capital, forcing cutbacks and layoffs that further reduced economic activity. By the late 1800s, the distinction between speculation and investment had really crystallized. Speculators chased short-term price movements, many times with borrowed money. Investors bought well-managed companies, held them for years, collected dividends, and participated in long-term economic growth. This represented a fundamental evolution. The South Sea bubble that we talked about last week treated stocks essentially as lottery tickets. Railroad investors treated them as fractional ownership of productive enterprises. This fundamental distinction between speculation and investment would later be formalized by Benjamin Graham, often called the father of value investing. Graham, who began his Wall Street career in 1914 and later taught at Columbia Business School, revolutionized investment thinking with his 1949 book, The Intelligent Investor. He argued that treating stocks as fractional ownership stakes in real businesses rather than lottery tickets or trading chips was the foundation of successful long-term investment. Graham's most famous student Warren Buffett, would later describe The Intelligent Investor as by far the best book on investing ever written, quote unquote, and credit Graham's philosophy as the cornerstone of his own investment success. So, we know about Ben Graham, and we definitely know about Warren Buffett as big names in the financial community. The railroad era established principles that govern stock markets today. Companies should provide transparent financial information. Stock prices should reflect business fundamentals. Diversification reduces risk, and long-term investment generally outperforms short-term speculation. These principles don't eliminate speculation. Human nature ensures that speculation will always be around, but they created a framework where stock ownership could serve legitimate purposes, financing productive enterprises, providing returns to savers and investors, and allocating capital efficiently. So we'll continue the conversation next week. Until then, I wish you grace, dignity, and compassion. My name is Andy Temte. This is the Saturday Morning Muse. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public good with family, friends, neighbors, and colleagues. The show was produced by Nicholas Temte, and we'll see you next time on the Saturday Morning Muse.